The October jobs report is released on Friday, and here with a preview is Thomas Simons, an economist with Jefferies. And Simon, it's good to have you here. Welcome.
Thank you.
So September was a pretty disappointing month for the labor market. Only 142,000 jobs were created. So how many jobs should we expect in October?
Well, the Jefferies forecast is for 185,000 jobs on the headline and 175,000 private jobs.
And are you expecting any downward revisions to the previous months? I mean, we certainly saw that in September.
We did. We're actually expecting upward revisions. We think that it's possible that there are some calendar fluctuations with Labor Day timing. It was later this year than it usually is. That created some distortions that will be unwound in the next report.
So even though we're still below that critical 200,000 job level, you're still okay with, 185,000 jobs?
Sure. I don't know that 200,000 is necessarily the critical level anymore. We've seen from various Fed officials they've been talking about a lower bar.
But it once was.
It once was, that's right. But as we're getting closer to maximum employment, which I think we are, we're not going to be able to grow a 200,000 clip per month consistently in the future.
Yeah, and aside from jobs, we'll also get another reading on average hourly wages. What are you expecting on that front in terms of a year-over-year increase for October?
Sure. 0.2 on the month, which should bring us up to 2.4% year over year. That's near the top end of the range that we've seen recently, but we think we're going to continue to see more gains going forward in the months ahead.
All right, and in terms of the Federal Reserve's looming rate hike, I mean, how important will this report be?
Well, it will be very important, this one and the next one as well in November. But I actually think that looking at inflation and commodity prices is going to be the real determinant. If we get a really weak report, I think it could take December off the table, but really things look like they're moving in the right direction for that.
Because in the Fed's October statement, it seemed as though the labor market was not the problem, it was more inflation.
Correct. Yeah.
Well, but what about inflation? I mean, isn't that what's holding the Fed back that would perhaps prevent it from hiking in December?
I would say so. The employment side of the dual mandate has been satisfied for many months. And if you looked at just that, the Fed could have hiked at the end of last year, for instance. But
sure. When GDP growth was strong.
Exactly. And payroll growth was over 300,000 several months at the end of the year last year, too. But commodity prices being consistently weak, having a downward impact on not only headline inflation, but now it's starting to trickle into the core as well. It's troubling. So I think that we need to see some stabilization in commodity prices. So I think so long as oil, for instance, doesn't fall in the next 6 weeks, 8 weeks, that I think that they'll be sort of satisfied with where we are.
All right, and Jefferies is in the December camp in terms of a liftoff. Tell me what could happen over the next 6 weeks or so that could derail that forecast, that could push the rate hike into March of 2016, which is when the markets are pricing in a rate hike.
Sure. I think that, again, if we get oil prices fall below $40 a barrel, for instance, if we start to see more weakness on core inflation, and also looking at these jobs numbers, if we fall down to, say, 100 to 110,000 per month or somewhere in that neighborhood, if the unemployment rate rises a tick or two, I think that it's possible the Fed gets cold feet. But looking at the composition of the board next year, I think that March will probably be where we go.
All right. Thomas Simons, an economist with Jefferies. Thanks very much for coming in.
Sure, my pleasure.
I'm Scott Gamm, and you're watching The Street.